A massive US debt auction just wrapped up. The US Treasury just sold $58 billion of Treasury bonds, and the results were extraordinary. And how is the bond market responding to Trump's stimulus check proposal? So, of course, today, some of the first price action in the bond market since President Trump floated the idea of what he is calling a tariff dividend check. Now, of course, very 2021 esque, very stimulatory, very inflationary. We know what happened to bonds. They got crushed during 2022 when inflation started to pick up, and then of course the Fed had to hike rates. We will see how the bond market is responding, especially the long end of the yield curve, since President Trump came out with that announcement yesterday. But first, we have a couple bond auctions this week, starting off with the 3-year note auction, short end of the yield curve. We can see the high yield, the auction cleared at 3.58%. Now, yields have ticked up by about 2 basis points since this auction cleared. Now, a stop through of 1 basis point, that is the largest going back to February. The stop through, what this means is that buyers were willing to pay a premium above and beyond what the bond was trading at going into the auction. As we can see, highest going all the way back to February, and the past 3 auctions in a row, we had a stop through. Again, indicating bond buyers at these auctions are willing to accept a lower interest rate. Remember, with a bond, the interest rate is inverse to the yield. So a higher price equals lower yield. They are accepting about 1 basis point lower interest rate on their bond than it was trading at going into the auction. Now, the bid to cover, 2.85, the 6 auction average, 2.58. So this bid to cover is the highest going back to August of 2023. Remember, the bid to cover represents the total amount of supply, total amount of bids divided by the total amount of supply. In this case, $58 billion in this 3-year note auction. Now, primary dealers, they took down 9.7%. Direct bidders took down 27.3%. And indirect bidders, that foreign demand, took down 62.9%. That is notably above the 6 auction average of 62% for that foreign demand. You want to see strong foreign demand, and you want to see relatively low primary dealer demand. And the reason is the primary dealers are the buyer of last resort. They have a special arrangement with the Treasury Department to basically be the buyer of last resort at these bond auctions. So if you see a large share of the auction had to be absorbed by primary dealers, that is generally not a good sign. However, as we can see, that primary dealer share of the total auction has been declining pretty notably going back to 2006, as evidenced by the chart. Now, if we look at indirect, that is in green, that is that foreign demand, again, stronger than the 6 auction average. That is always a good sign. And direct bidders, those are firms bidding directly for their own book. We can see that generally that has been increasing in terms of the share that that direct bidders and indirect bidders have been taking up in these 3-year note auctions. Now, the red line shows the bid to cover. Again, that is the total amount of bids divided by the total amount of supply. We can see, again, the high is going all the way back to August of 2023. Hopefully, it is intuitive that having a high bid to cover indicates strong demand. If we go back to the results here, 2.8, what this means is that 2.85 bid to cover, there were 2.8 times as many bids as the Treasury was actually trying to auction off. So hopefully that is intuitive why that is a sign of strong demand. And of course, we had the 3rd stop through in a row indicating bond purchasers at this auction were willing to pay a premium and accept a lower interest rate. And of course, also indirect demand quite strong above the 6 auction average of 62.3. So moving on to how the bond market is responding to this notable proposal from President Trump. A couple of points to make about this $2,000 Stimmy check thing. So annualized out, the tariff revenue per year is about $350 billion, assuming tariff rates don't change too much. The US Treasury is currently collecting about $350 billion per 12-month period annualized out. Now, if you take the total civilian labor force of 170 million people and you multiply it by $2,000 Stimmy checks like he is proposing, you get basically the entire tariff revenue for an entire year. Now, this is important for two reasons. When you helicopter money directly into people's bank accounts, like the Stimmy check, like back in 2021 and 22, that is very inflationary. That money has a very high velocity, and especially the lower end of the K, those lower end consumers, their marginal propensity to consume and to spend that dollar is much higher. And so, therefore, has higher velocity and can be much more inflationary because it is not being saved. Generally speaking, those Stimmy checks, they've done a couple studies and found that about 90 to 95 cents out of every dollar that went in the Stimmy checks back during the prior era, that went to spending. Now, this can also, of course, pump asset prices. We saw, of course, pretty strong asset price performance, whether it be housing, whether it be the stock market. Of course, we had the whole meme stock thing. Cryptos were generally doing quite well during the Stimmy check era. So it's inflationary, both from a consumer price index point of view and from an asset price point of view, number one. Number two, it's important to point out the bond market's basically priced in the fact that the deficit that the Treasury Department will collect about $350 billion of tariff revenue every single year. The bond market is basically priced that in. So if you basically negate that or reverse that and start giving the entirety of that revenue, that annual tariff revenue, back into the hands of consumers, well, what that means is the deficit is going to go up by $350 billion. That is the amount being given and is basically being taken. And instead of buffering the deficit and helping to reduce the deficit, well, now all of a sudden, the Treasury Department's got to come up with an extra $350 billion. We know the US runs a twin deficit, current account deficit, and a fiscal deficit. And currently, that deficit is on the order of about $2 trillion. So, if he were to do this proposal, it would basically increase the deficit by $350 billion. What that means, again, what the deficit represents is the amount of bonds that must be issued every single year. So right now it's about $2 trillion. That's the gap between spending, which is about $7 trillion, and revenue, which is about $5 trillion. That gap must be issued in new bonds every single year. So it would increase the deficit from at least what the bond market has sort of priced in. Again, the bond market has sort of assumed, okay, 350 billion, that's about the tariff revenue that we will be getting, and therefore adjusting, of course, their demand or their supply expectations. Because remember, if you increase the supply with a very, very large deficit and demand stays constant, what must the price do? It must go down. Well, with a bond, that means a higher interest rate. So we need to watch especially the long end of the yield curve again, which priced off of those nominal growth expectations and some of that fiscal concern as well. We can see that the 30-year yield since the Fed started to cut interest rates is up pretty notably, about 80 basis points. The 10-year yield is up as well. The 5-year yield is up as well, as is the 2-year yield. So the Fed has been cutting interest rates, but the long end of the yield curve and part of the belly of the curve as well, the interest rates have actually moved up. And sure enough, since the Fed cut interest rates at this last meeting, the 30-year yield has basically gone straight up with some volatility. Same is true for the 10-year yield. Now, if you look at the spread between the 10-year yield and the Fed, it is actually near the highs for the past 2 years. So this is definitely something to keep an eye on. We can take a look here at Fed funds for the next meeting in December. There is a 63% chance of a rate cut. If we go to January, that jumps to 76%. And if we go to March, the odds are 86% here. So remember that the short end of the yield curve basically leads the Fed. So what the 3-year note auction indicates, or what the short end of the yield curve, again, we established the long end is priced off those nominal growth, inflation, fiscal concerns, and that sort of thing. The short end is priced off of what is the Fed going to do. And as we can see, the 2-year yield basically leads the Fed, and the Fed just simply follows what the massive US Treasury market is already doing. So that's that's why it's important to keep an eye on the short end of the yield curve, like the 2 year or the 3 year. Strong demand, again, means lower interest rates. That is what you would expect to see if the bond market was expecting Fed rate cuts. Now, moving on to the long end and how it responded. Sunday evening, yesterday, the bond market opened up and the 30-year yield had gapped up to 4.73. And then it started to move higher. So generally not a good sign. Generally, you don't want to see long end rates doing that, gapping up and moving higher. But as we can see over the past 18 hours or so, we have seen that 30-year yield come down. But there's been some significant volatility with the 10-year yield and the 30-year yield over the past week or so. The yield curve has steepened. It's been a mix of bull and bear steepening, but it has steepened nonetheless. If you start proposing very stimulatory, very inflationary, very populist sort of policies, expect that the bond market is not going to like it. Now, very important to point out, the betting markets only have the odds of Trump actually following through with this tariff rebate check, or whatever you want to call it, at 10%. So people are very fading Trump's bluster, because everyone basically knows at this point that he will just say things and then never actually ends up following through. So again, I would watch the betting market because right now it's only priced at about 10% probability that those tariff checks actually end up coming. And again, it would increase the deficit by about $350 billion. That is not insignificant. So the bond market would need to adjust again to that increase in bond supply. Assume kind of constant demand. Of course, demand might go up at the short end, for example, if Fed rate cuts are expected. So these are fluid sort of dynamics, and that is probably why we saw a strong demand here today at the short end of the yield curve, is again, expectations of more Fed rate cuts. If the bond market was not expecting Fed rate cuts, you would see probably pretty poor demand. But recently, we have seen strong demand that has coincided with the Fed, of course, last meeting cutting interest rates. Andy Constant, by the way, gave this 3-year note auction an A+. So extraordinary results. Anyways, hopefully that was helpful, and I will catch you on the next one.